topic of today's discussion, just heads up that this product is not going to be approved, nor do we anticipate it being ever approved in California. There's a couple other states that are unique as well. But again, in this day and age when people are getting more and more into remote internet-based selling, more and more of you are getting non-resident licenses outside of your home state, which is great. And so this product might have a chance to touch you somewhere else in a different opportunity. I do have everybody in a listen-only mode because I am recording the session today. So if you do have questions along the way, feel free to use that question feature. In the toolbar on the right-hand side of your screen, type those in. I'll do my best to keep an eye out for those as they tumble in and address those either privately or to the whole audience. But it is my intention to unmute everybody toward the end of the call to field any questions that may come up along the way. So with that, why don't we go ahead and get started. I actually do have an agenda I want to follow today. I think it's important to make you feel more comfortable and confident working with a company like Guaranteed Trust Life. So I'll give you a little bit of company background. The niche and the need, we've brought this up over the last 2 to 3 years with this product under the name of critical care. But again, just to remind you as far as where we think the niche is for this and why we had GTL work with us to develop such a product. I'll go through a little bit of comparing the current product, which is the critical care product, with the new one. It's not a replacement policy. It's just the way in which you go about constructing the policy is a little bit more creative. I will go through plan details, get a little bit into the underwriting so you have a better understanding of how this product works. It is not a guarantee issue product. They do underwrite. There are conditions where you can go there, and there are quite a few conditions where you cannot go there. I'll step you right through the very brief 1-page 5-question application, show you how the rate calculation works, and then open it up for Q&A. So again, Guaranteed Trust Life, they have been around for 80 years. They're a privately held mutual company just outside of Chicago. And what we like about them is ever since we started working with them back in 2012 is their trend. Everything seems to be trending in the right direction with them financially. So you should feel confident in working with them because they are trending up. They are the #1 provider, for example, in the U.S. for a niche product called hospital indemnity, which is a huge senior market item to augment Medicare Advantage policies that are being sold by agents across the country. During the annual open enrollment, which we're going through right now, they'll put about at least on the average, about 2,000 policies a week during the annual open enrollment to help supplement the co-pays on those Medicare Advantage plans. So again, just to show your trend, since we've been working with them now for the last almost 4, if not 5 years, their income is going up, their net gains are going up, their surpluses are going up. Just got a quick question. I am not broadcasting on the internet today, so hang on. Okay. So like I said, it's all about the trends with us. And then just recently, this past spring, AM Best came in and did another review of GTL and did upgrade them from a B+ to a B++. So again, it's another indication that they're going the right direction. The next step, hopefully this next year, will be to see an A- show up there, and they are cautiously optimistic this will happen. So just to show that you should feel more comfortable. All right, just to have you feel a little more confident and comfortable representing a company like this. They have been around for a long time. They're in the 3rd generation of being privately owned. And again, it's all about trend as far as we're concerned. Typical spreadsheet for their investment portfolio of a mutual company where the majority of their investment is in bonds. That just shows a conservative approach, very similar approach to like Mutual of Omaha's investment portfolio itself. So what do they do? I mean, what type of products do they offer? They are a real, we call a niche insurance policy type company. They have a traditional critical illness product called cancer, heart attack, and stroke. It's a lump sum product. They have a term life product that has a critical illness rider available to it in critical provider. Their mainstay is right there in the center, the Advantage Plus. That's their hospital indemnity plan. They just have been kicking some new life into that product this year by enhancing it, by allowing you to buy fewer days per year coverage, and even a little dental vision rider for additional benefit. The Recover Cash is a short-term product. Similar, in fact, to a long-term care policy, but again, it's short-term, so it's less than a year. It's an indemnity offering for that marketplace. And then again, with critical care, we launched critical care with GTL here three and a half years ago. It was a niche product that they developed with us for a potential landing spot for those who would not qualify for a traditional long-term care policy. So why critical care? Why critical cash? Just a few statistics here as far as long-term care claims. Just to give you an idea of how large the claim market is, $7.5 billion in claims were paid out in 2013. That number has gone up in 2014 as well. Almost 300,000 in new claims opened in 2013 alone. 70% of those claims that have opened are tied directly to Alzheimer's, stroke, and cancer, three of the conditions that are covered by this critical care, now critical cash policy. So there's kind of a common ground between this critical illness policy called critical care and a traditional long-term care policy. It's kind of a hybrid between the two because it does have a benefit there if the diagnosis of a covered condition lands your client into a long-term care facility like assisted living or nursing home. So again, we kind of feel like it's a meld. Critical illness market is getting stronger and stronger every day. It's huge in the worksite market through companies like Colonial Life and people and companies like that, Aflac and other. It's anywhere from a $4 to $6 million, or actually a $400 to $600 million annual business for critical illness alone. We all know where long-term care is, so this is kind of a merger of the two into a product that we initially rolled out 3 years ago called Critical Care, and now we're excited about rolling out this enhanced version of the same policy. So we're evolving into the generation number 2 of this new product. As we all have experience, of those of you out there who have been selling traditional long-term care for a while, we've been watching the trends over the last 5 years, even 10 years. Decline rates are going up. And they're going up significantly in certain age bands over others. But the trend is that it's harder to get somebody through the underwriting process with traditional long-term care. So you need other places you can potentially go so you can get your clients some kind of coverage, because having something is by far better than having nothing. I'm going to walk you through a few of the conditions here that most long-term care carriers would not touch with a 10-foot pole, but may be an acceptable scenario for this product from GTL. Disability income. That is normally a knockout question with any traditional long-term care, whether it be your traditional reimbursement or even the hybrids for that matter. But SSDI is not an issue or concern with GTL for the critical care product. Some of your autoimmune diseases like lupus, scleroderma, or connective tissue disease, if you have people using walking aids, including a walker or even a wheelchair, that is not a real concern to Guaranteed Trust Life. They could actually be exhibiting ADL issues and qualify for this product with GTL as well. We know back issues are huge with long-term care as far as a no-go. Use of narcotic pain relievers is a no-go with traditional long-term care. Again, not an issue here with Guaranteed Trust Life. Some of your mental disorders become challenging, where you have severe depression, anxiety, schizophrenia, even people that have memory issues but have not had a clear diagnosis of dementia or Alzheimer's. That's a touchy one, as a few of us do know, but that's a potential place where you can go. Continuing on with that same thought, you've got severe osteoporosis. They don't care about T-scores. They don't care if you've had fractures. Again, it's not a concern because this is critical illness insurance, and it's not a long-term care policy. Heavy-duty diabetics taking more than 30 or 50 units per day, and if the only knockout, the only concern that they have with diabetes is it has to be diagnosed after age 50. A lot of people are in PT for whatever reason. It makes them feel good. And if they're currently in PT, that can knock them out for a traditional long-term care product. Again, not a concern here. Ongoing joint pain, getting cortisone shots. If you have people that had recent or severe cancers, they can be cleared to buy the Cardiac Care Plus product from GTL. And I'll get into the 3 different policy designs here in a minute. Combination pacemaker defibrillator. That would knock them out of the heart part, but they can get the Cancer Care Plus. RA, with heavy use of prednisone or methotrexate, again, not a concern. And overall, like I mentioned earlier, narcotic use, tramadol, PRM, whatever, or post-traumatic stress syndrome. So just a feel for some areas where we see a lot of declines in these areas, and that, to us, is an opportunity for you to go back and talk to these clients about the GTL offering. So it kind of goes places where long-term care doesn't go, and it goes other places as well. But again, it's not ADL driven, so there's no magic triggers. The way in which you qualify for a benefit on the policy is the diagnosis. There's no 90-day plan of care expectation. There's no elimination period. The only waiting period you have with this policy is what they call a 30-day wait period, which means you cannot claim into the policy within the first 30 days of owning the policy. There's no documentation or no accountability for the money that you spend. It's a pure indemnity type policy. And as you will see here in a few minutes, we kind of kicked it up a notch or two on the indemnity part of the policy as well. And again, whoever wants to give care, they don't care. You get the diagnosis, you get the money, you spend the money however you wish to spend it. There are a number of conditions that are covered by the GTL product that perhaps would not trigger long-term care. Heart attack, bypass surgery, kidney failure, organ transplant, those are all acute type of things that may not make somebody ADL deficient. So if that's the case, but they would trigger a benefit in this policy, but your long-term care policy would never trigger in. And on a side note, I mean, there's no special training. A life and health license is all that is required for this. However, we know that majority of you out there will be viewing this as a place to go when you can't place somebody in a traditional long-term care environment. So where is the product going to be available? Actually, it's in quite a few states. The critical care product is up and running currently in 37 states. And this product is going to be replacing the critical care product as these states roll out. The reason why there are a few states in green, those states actually rolled out as being available October 1. And when GTL says available, it means it's fully available up to and including available up on their website, on their e-app. So Alabama, Arkansas, Hawaii, Idaho, Indiana, Iowa, Maine, Mississippi, Missouri, North Carolina, Oklahoma, South Dakota, Texas, West Virginia, and Wisconsin. Those states are all up on GTL's agent portal for quoting purposes and to enroll people. The states that are in black, Alaska, Arizona, DC, Delaware, Illinois, Kansas, Kentucky, Maryland, Michigan, Montana, Minnesota, Nebraska, New Jersey, New Mexico, North Dakota, Oregon, South Carolina, Tennessee, Wyoming. These states are all coming on board next week on the 23rd. Right? No, it's today. I'm sorry. It's today on the 23rd, paper app only. Followed by a month later, they'll be available up on the agent portal for online quoting and the electronic app. We have materials here now for all these states, and so all you need to do is give us a call or pop us an email, and we'd be happy to send out supplies to you as well. So there's a brochure, an application, and the agent guide. And in the agent guide, The rates are in the agent guide. It's a little fairly simple rate book to figure out, along with some underwriting tips. They've actually taken the time to list out some health conditions that are tied to the general categories that they have in the knockout section of the application, which I will get to in just a little bit. So you can see it's a rather robust initial rollout. It will probably never exceed the original 37 states. Just keep in mind, this is not a new policy. It is the exact same policy that critical care is. It's just the way you go about building the policy, approaching the building the benefits of the policy is different. So the policy itself is not changing at all. So there are two key things that we've done with the policy. If you recall, with critical care, when you were building a policy, you selected a monthly benefit, the minimum being $500, the maximum being $3,000 a month, and a benefit period, whether it be 6, 12, 18, or 24 months. With the new restructure of the critical cash policy, we separated the base benefit from the facility benefit. So you make two decisions. You make a decision on what you want your monthly base benefit be. Some of you kind of equated it to a home care benefit. And then the second decision you make is what would you like your facility benefit, which would be nursing home assisted living, monthly benefit to be. The two combined cannot exceed $6,000. So now you can buy a $1,000 base benefit, and then you can buy a $5,000 nursing home benefit for a combined benefit of $6,000 a month if you are confined to a nursing home benefit. This will, and what you'll see here when we get to the pricing is that the premium load for the facility side is very, very cheap, affordable, inexpensive, whatever term you want to be. An example that I'll have here on the screen here in a minute or so is if you were to build a critical care policy today at a $2,000 monthly benefit, knowing that it doubles to $4,000 if you're confined to a nursing home, take that same policy and build it with a $2,000 base on the new product and a $2,000 nursing on the new product, the premiums would be identical. So we haven't changed it. However, if you want to take the approach of buying a $1,000 base in a $3,000 nursing home, you'll see that in a minute here that the premiums are significantly less than the critical care product with the $2,000 base doubling to $4,000 for a nursing home. On top of that, we have allowed the policyholder at claim time to collect the base benefit lump sum. So if your client had a $1,000 base benefit for an 18-month policy period, and then also another $4,000 nursing home benefit, and they claim for a stroke, they could request a check and get it for $18,000 lump sum on the base, or they can request to have it paid out on a monthly basis. So they can get the money all up front, and then they can spend it to their heart's desire. And if they're confined to a nursing home facility, doing rehab from having a stroke, they'll get an additional $4,000 a month on top of the base, because you always get the base first, and then whatever facility benefit if you're confined to a facility, on top of that on a monthly basis. So they're lump summing the base benefit. The facility benefit still pays out on a monthly type basis. So all the plans are the same. Like I said, there's no change to the policy. There are 3 plans available. The comprehensive plan, which covers cancer, cancer in situ, heart attack, stroke, coronary bypass, Alzheimer's, kidney failure, organ transplant, paralysis, and coma. And then you have a flavor. If you've had heart issues in the past 10 years, you can get the Cancer Care Plus. So it covers cancers and then the other 5 conditions. And then again, if you have had cancer issues or in the past 10 years, you can get the Cardiac Care Plus. So again, you build the policy the same way you did with critical care. You select a benefit period, 6, 12, 18, or 24 months. Keeping in mind that there are a few benefits of the policy, just like in critical care, that have a limited benefit. The cancer in situ, the heart attack, and coma are limited to 3 months, and the bypass surgery has a 2-month limitation. Otherwise, all the other covered conditions will pay out for whatever benefit period you selected or your client selected. So a few limited, but most all pay out the full benefit period. Then you select your base benefit. So you'll go to the rate book, and it'll be the minimum 500, the maximum 5,500 in $250 increments. And an example of that would be if you chose a $2,000 monthly benefit for 24 months and you claim for a stroke, you can request a lump sum check of $48,000. And bam, this is where it kind of gains more flavor of a traditional critical illness policy, like a cancer, heart attack, and stroke policy, where if you claim, they just write you a big check, and then you're off to the races, and you can spend that money however you wish to spend it or not spend it. So you make the decision on the base, and then you make a decision on the facility benefit. Again, same criteria, minimum 500, maximum 5,500, but again, the two combined, the base and the facility benefit, cannot exceed 6,000. And when you choose the nursing home benefit, whatever that dollar amount is, half of that dollar amount will be paid out if you're confined to a licensed assisted living facility. So again, no real change on the policy itself. It's just the way you go about building it, and also another way in which you can collect benefits. The same restoration of benefits feature is in the critical cash that was in critical care. The policy benefit period will continue to restore as long as there's been a 12-month gap between the end of one claim and the beginning of the second claim for another reason. You can keep claiming against the policy until the policy is completely gone. Similar to long-term care, you do develop a maximum policy benefit. Over time, there's an equation where you take the base plus the nursing home times your benefit period times 3, that establishes the initial policy limit for the policy. And again, you can keep claiming until that bucket is dry, as long as there is at least a 12-month gap between the end of one claim and the beginning of the other. When we were first doing training on the critical care 3 years ago, one of the analogies we used was, I just drew a blank, I'm sorry. Oh, God, never mind. I'll come back to that one. Anyway, you can claim multiple times into the policy and until the pool of money is gone. Here's that math again on establishing the policy maximum. So again, you take your base plus the nursing home benefit times your benefit period times 3. In this case, it will be maxed out the benefit at $1,000 base, 5,000 nursing homes, so 6,000. We bought a 24-month policy and multiply that number times 3. You have a policy limit of $432,000 for that particular policy. So again, there's no elimination period. There's no chronic ill requirement. It just, you get a diagnosis, it's documented by your doctor, bam, you get a check. And there's no reassessment, there's no assessment. The company's taking your doctor's word for it. He's got chart notes to back up that you have a diagnosis of cancer or a diagnosis of stroke or a heart attack for that matter. So again, it's face value, very simple claims process to initiate. Walk you through a quick example here. Bob bought a policy with a $1,000 monthly base and a $5,000 facility and an 18-month benefit period. He claimed, and his first 3 months on his claim, he was at home. So he chose the lump sum payment payout of $18,000. So he got $18,000 for just being home for 3 months. It doesn't make any difference how long you're home, because you can lump sum the whole base benefit if you're outside of a long-term care facility. But then for whatever reason, Bob, for the next 15 months, was confined to a nursing home. So he now collected an additional $5,000 a month for 15 months, equaling $75,000. So in that example, the policy paid out a $93,000 benefit. There is still the same return of premium rider available on the policy, the same kind of a rate factor. It's not very expensive because the return of premium rider goes away at age 80. So you have to, if you buy the rider, you have to pass away prior to age 80 in order for that benefit to work. If you pass away after your 80th birthday, the ROP rider goes away. So I'm going to walk you through a couple of comparisons of actually comparing Plan A, Plan B, and Plan C. I know when we did the training for critical care, we showed you the savings of buying a Plan B versus a Plan A and a Plan C versus a Plan A. This still carries over onto the critical cash product. The example we use here is a $1,000 base with a $5,000 nursing home, so a combined of $6,000 for a 24-month period of time. It just shows the top one shows actual premiums, the annual premiums. The bottom shows the percent savings. So on the Cancer Care Plus versus the fully comprehensive, it's about overall a little north of 30% savings to buy the B versus the Plan A, and a lot more significant savings if you buy the Plan C over the Plan A on the Cardiac Care Plus. I'm going to walk through the application here in just a second, but before I do that, I'm going to check to see if I have any questions typed in. Okay. I got a lot of questions here. I think I'll save these toward the end, and I'll pull them up all individually and go through them one by one. Okay. So again, the application process is quite simple. It's 5 simple yes/no questions. The first 3 being basically a knockout. If any yeses show up there, do not proceed. The company does run a pharmacy check, and they also run an MIB report. They may call your client to verify or get a clarification if something weird or questionable shows up on the RX check or the MIB. In rare cases, and it's still tracking at about 10%, they will request medical records from your client. And if that request does come through, your client has to achieve those at their expense and get them to GTL to continue the underwriting process. But again, it only happens in about 10% of the cases, and we're still averaging somewhere between 85 to 90% issue rate with the policy itself. Not bad. So you have your the very first question are the heavy-duty knockouts. And some of these categories, or some of these named things here are fairly broad, like central nervous system disease, what falls into that category? Or respiratory or lung disease chronic, what falls into that category? So you'll be pleased to see in the new agent guide, besides having the rates, it's going to have some medical conditions that will be tied back to central nervous system disease or tied back to chronic respiratory or lung disease. So you'll know whether or not a named condition is covered under those kind of a broad type categories. Otherwise, they're pretty straightforward. These are, for the most part, the standard type knockouts you see on a traditional long-term care. But again, it's not all encompassing or not nearly as in-depth as it is on a traditional long-term care product itself. And you always have the ability to call underwriting at GTL to preview a case ahead of time. The more field underwriting you can do, the more positive your experience will be with the underwriting process overall with GTL. Question number 2. Again, a yes means non-insurable. So in the last 5 years, has anyone proposed for insurance been treated for drug or alcohol abuse? Or are they currently confined to an assisted living or a nursing home? Again, yes is a no-go, no is cool. Number 3. In the last 24 months, has the applicant had any abnormal tests, awaiting test results, or been advised to have a test, or had a medical condition, symptom or abnormality that would cause an ordinarily prudent person to seek medical treatment, but has not yet done so? So that's the third knockout question. Overall, a yes to this question, then they are uninsurable. And now we get into where you can have a yes or a no, because this will tell you if your client is going to qualify for the fully comprehensive Plan A, or the Cancer Care Plus, or the Cardiac Care Plus. So if you've had 4A, for example, are all around the cancer. So if you had in the last 10 years, if you have to say yes to any of these issues around cancer, excluding basal or squamous cell skin cancer, then you're relegated to the Cardiac Care Plus. If it's been longer than 10 years since you've been treated for that type of cancer, then you can truthfully say no to this question and get the fully comprehensive Plan A. The same holds through on section B of the question, where if you've had any heart issues, and this is where diabetes dials in, insulin-based diabetic and diagnosed with diabetes prior to age 50. That's a knockout for the cardiac part of the policy, so your client will qualify for the Cancer Care Plus. After you answer the questions, there's a brief area where you can list out any meds you're on, the reason you're on meds. In the agent guide, there's a list of forbidden medications. So basically, if you're on this medication, it's been acceptable. Keep in mind that there's off-label use for a number of medications. I'll give you one example. Maripex. Maripex is a very common drug to be used for someone who is being treated for Parkinson's, but it also is a drug that is used for people with restless leg syndrome. And in that scenario, it's perfectly acceptable to GTL if it is being used for restless leg. I would just attach some kind of an addendum to the application laying that out. And again, the bottom of the app is just where they record their answers, whether it be yes or no's. Any yeses on 1, 2, or 3, you're out. A no on 4A or 4B will relegate you to one of the two, Plan B or Plan C. Now we'll get into the rates. So the rate book is a little more in-depth than the rate book for critical care because you have to break out and show rates for the base and then a separate set of rates for the nursing home / facility benefit. And then you have to, the first place you have to make the right decision is if you're trying to price out a Plan A or a Plan B or a Plan C. And then you have to get to the right benefit period. So there'll be a whole section or a page devoted to a 6-month base plan, anywhere from the minimum of 500, which is up here, to the max of 5,500 down here. And then the bottom half of the page will be the 6-month for the nursing home, 500 down here, and it gets cut off, but down the lower right-hand corner would be 5,500. So there's a whole page for Plan A for 6 months, a whole page for 12 months, a whole page for 18, and a whole page for 24 months. Okay. So one thing we wanted to point out here, and I told you where there's some significant premium savings to be had. As an example, a $1,000 base amount on a 6-month benefit period for a 55 to 59-year-old is $277.52 per year. Let me get to a younger. I'm going to do a 40. I'll do a younger one, so I'm doing a whole thing here. Let me get my mouse back. It's $124.32 a year for someone between 40 and 49. That's the base benefit, $1,000 a month for 6 months. To add the nursing home benefit of $1,000 a month for 6 months to that same person only costs $1.36 per year to add that nursing home benefit. So you can see how inexpensive the facility side is. So again, we're showing you here the $4,500 nursing home benefit. This is something you may have already talked to long-term care about buying, say, a $5,000 or $5,500 per month long-term care policy. They just can't cut the mustard through underwriting. For a client who's between 65 and 69, it's only $221.94 a year for a $4,500 per month nursing home benefit for a year. And you can even jack that number up to a $5,500 monthly benefit, and it's only $50 more a year to get $5,500 a month while you're in a nursing home for 12 months. As I mentioned a couple minutes ago, there's a list of meds that are tied to either the Plan A, the Plan B, or Plan C that your client cannot be on to qualify for coverage. They're covered quite well in the agent guide itself. And they give you kind of a little rate calculation worksheet in the agent guide to help you kind of walk you through building a policy. Height weight chart. This is the only thing really new in underwriting with critical cash. They are introducing a height weight chart, male, female broken out. If you're familiar at all with Mutual of Omaha's underwriting guide, the high-end weights on this chart are pretty darn close to the high-end weight for a Class 1 with Mutual of Omaha. Again, this is all contained in the new agent guide. So critical care states are still not using height weight. It's only as the state launches with critical cash that they will be using the height weight chart. I alluded to an analogy earlier in the talk about building a policy the traditional way on critical care, where you select $2,000 base, and which doubles to $2,000 in the nursing home. For a client between 65 and 69, that would have cost $3,000 a year premium. If I went one way and overly inflated the base benefit and underinflated the nursing home benefit, therefore I accelerated the base benefit to $3,000 and had a $1,000 nursing home, you'll see the premium goes up by quite a bit. But if I go the other way, and I do a $1,000 base with a $3,000 nursing home, that still gives a client a $4,000 per month benefit if they're confined to a nursing home. Their premium is only $1,770. So it's almost half of what the critical care policy cost for the same overall nursing home benefit that you're selling with critical care. So you can play with these numbers any way you want. And again, if we really max the whole policy out and minimize the base at 500 and maximize the nursing home at 5,500, we're only talking $1,200 a year for that policy. That can fall back into the affordability range for your client. So just food for thought. Couple of busy slides here. We just wanted to show some additional savings to be had by comparing the base premium to the nursing home premium in certain age categories. So you can see how light the load is for the nursing home versus how the load is really on the base. So for a 60 to 64-year-old, $1,000 base is about the premium, combined premium is $1,200. Of that, only $47 a year is the load for nursing home. And as you get older, the percent actually goes up a little bit, but it's still fairly reasonable. So you have a more elderly 70 to 74-year-old, the load on a $1,900 premium for a $1,000 base and a $1,000 nursing home, the nursing home component of that is only $153 a year. So it is pretty reasonable for that scenario. So we have a couple of sales scenarios here. One's called the LTC load. What this is you may have clients that bought a long-term care policy a long time ago, 15, 20 years ago, and they didn't buy inflation for whatever reason, so they just keep their premiums down. And now they're to the point where they would to buy a traditional long-term care policy. If they could qualify, the premiums would just absolutely kill them. So you could approach these people about adding another policy, a critical cash policy, to their portfolio, to help them out a little bit in case something happens to them at an affordable type premium. So this scenario here, we did a 2-year plan, little base 500, nursing home benefit of $2,000, so it would be a $2,500 per month benefit if that person was confined to a nursing home. It would give her a $12,000 lump sum upon diagnosis, an additional $2,000 a month if they're confined to a nursing home, or an additional $1,000 a month if they were confined to an assisted living facility, for an annual premium of about $1,500. And that's pretty reasonable for someone who is 79 years old. So if we were to take that same person and try to stack a traditional long-term care policy on them, you can just imagine what the premium would be. It's more than double. So that's just dropping a 2-year plan, $2,500 per month benefit, no inflation with a 90-day EP, would be $3,700 for a 79-year-old. Plus, you'd have to get that person through underwriting as well. So again, it is a value, tremendous value, and it does add value to your client base to add this additional benefit on there. It could also go along with augmenting Medicare Advantage. I mean, it can augment anybody for that matter, because at the end of the day, it's really a critical illness policy that happens to pay an enhanced benefit if you are confined to a long-term care facility. But again, that lump sum feature up front as far as the base can go a long way to help your client. I already went through kind of the outdated coverage idea as far as a person that bought a policy a long time ago. I mean, it wasn't that long ago that assisted living facility benefit were not in long-term care policies. Your only hope was to have it be covered by the alternate plan of care language. Well, you know, this could help fill that void because there is that assisted living facility benefit built in there as well. Maybe you have an older policy that's been sitting out there and it's got a 90-day elimination period. You know, you can build a policy like this with enough base benefit or enough base benefit to cover the cost for that 90-day elimination period for the long-term care policy. Just an influx of cash to help people out when they're having a tough time. And here's an example of how different ways you could fund and come up with an $18,000 figure for a pretty reasonable premium using the critical cash product. A little bit busy here, but you know, just different. We're just trying to plant some seeds with you to think about different ways in which you could use the critical cash policy beyond just a potential savior for your traditional long-term care declines. Oops, back up one. So I've got a lot of questions here, so hang on, I'm going to get back up here. I'm going to go through, and for those of you who dialed in that audio pin, I'm going to unmute your line. And I'm going to go through and look at all the questions and try to address those to everybody here that's on the call. I will ask if you have me, if you are dialing in the conference line, if you have me on speakerphone, if you could please mute it, that would be great. Okay, let's see. Again, this puppy is not in California. Okay. And it probably won't be, but if you're in California and licensed outside of it, it could work quite well for you. This is a critical illness policy. It is not a life policy. There's no accumulation of cash value at all, so just keep that in mind. Let's see, next one. It is up and running in Colorado. Colorado hasn't approved critical cash yet, but the critical care product is up and running in Colorado, so I would say look for the critical cash to be there soon. What about Penna? Are we talking Pennsylvania? Not sure. I'm not even sure if the critical care products are approved in Pennsylvania this time. That's not a state we focus on. And
so it's not you don't have a product in Pennsylvania?
I don't think. You know, if you would not mind reaching out to me after the call, I can go look at their. Well, hang on, I got the state approval list right here in front of me. Let's see, Pennsylvania. The critical care product was never approved in Pennsylvania, so this product will not be approved there as well.
Okay.
You can claim more than one time for a cancer, as an example. And it has to be a new diagnosis or a diagnosis of a reoccurrence as long as there's been at least a 12-month gap between the end of one cancer claim and the beginning of another. It cannot be a continuation of the same cancer, so it has to be a new diagnosis of a reoccurrence of a cancer for it to pay again. But yes, it can pay multiple times for cancer. And yes, you do have to choose, at a minimum you have to choose a $500 base, and at a minimum you have to choose a $500 nursing home. But beyond that, the sky's the limit. You cannot just buy a base, and you cannot just buy a nursing home type policy. You have to make a decision on each of those categories to build a policy. Oh, thank you, Penny. It was Dick Cheney had 5 heart attacks while he was in office. All 5 heart attacks would have been, 4 of the 5 heart attacks would have been covered by this policy. And yes, we do anticipate this being in Washington. It's not going to be this particular round, but probably look for it in the next month or two. They're still waiting for the final rate structure to be approved in Washington. The policy is already approved because there's no change to the policy. Critical care is alive and well in Washington State. So this new package is not quite there yet. Any other questions? I've got everybody unmuted who I could unmute. If anybody is still out there and has a question, feel free to type in. I think I addressed all of the questions along the way. Okay, we're excited about this. We were jazzed about the critical care product 3 years ago. We think it does have an appropriate fit in your portfolio offerings, a potential safety net for those who would not qualify for traditional long-term care. We just think we took a giant leap forward with this new approach as far as unbundling the nursing home, and you can build a policy that makes a lot of sense. You can really load the nursing home benefit, back off on the base, show your client that big nursing home benefit because you were already potentially talking to them about a big nursing home benefit at a pretty darn attractable premium. You know, again, it's a critical illness policy. There's no inflation protection. It is what it is. If you have a $500 benefit today, it's going to be $500 a day. You know, $500 benefit 15 years from now. That's the nature of this type of insurance. No waiver of premium. You're paying premium while you're on claim as well. More of your insurance you're used to seeing, LTCi insurance, is a unique form of insurance where you actually stop paying premiums while you're on claim. So I hope I was able to age last birthday as far as pricing a policy. And once critical cash rolls into a state, it's going to replace critical care. So you can't have your choice of getting underwriting without height weight versus underwriting with height weight. So once there'll be a published set of cutoff guidelines in states where critical cash is approved, the cutoff for critical care apps coming in from that particular state versus only accepting critical cash applications. We'll try to get that information out to you all soon. And can they convert? Yes, they can't convert, but they can reapply to replace. We've already got that approved through the underwriting process. From a commission standpoint, it's not going to pay you a whole brand new first-year comp at the higher level. Wherever your client is, however long they've had the critical care policy in place, the new one will just pick up where that first one left off. So if you just sold a critical care 6 months ago and you sell it replaced with a critical cash, you'll get 6 more months of first-year comp on the critical cash. If they're already out of their first year and they're just in their second year and you're getting a renewal stream, that's all you will get on the critical cash commission is the renewal stream. So again, you start off with a whole brand new app. Okay, I think that's it. I've taken up quite a bit of your Friday morning, so I do appreciate you again joining me today. Hope you got a lot of good information out of this. Again, we got a boatload of states rolling out here today. We have all the materials here, so please call our office. You have our number. If you don't, it's 800-672-7202. Ask for supplies or ask for a marketer. We'll be happy to get an order in the system and get materials headed your way as soon as possible. So again, thank you again for taking the time to join me. Have a great day and enjoy your weekend. Bye-bye.